Today, folks, in these perplexing markets, we got to ask ourselves, how is inflation, interest rates affecting the end consumer when it comes to these Canadian bank earnings? Because we've been getting some juicy dividend increases for those of you looking for some cash flow. And I want to break down the mixed bag that we've seen over the last month, because all these banks have posted earnings. And if you own an equal weight bank ETF, like the ones I like HBNK, you've been seeing nullified growth because the best performers like National Bank that have been exploding have been kind of getting de-weighted down by things like Toronto Dominion Bank that, based on money laundering stuff and drug, all kinds of crazy stuff that's been in the media has been destroying the stock, even though the earnings were quite good, which could present a buying opportunity. Who knows? I have big exposure to these companies because I buy VDY till I motherfucking die. My favorite Canadian ETF that's actually been outperforming the H Bank ETF or the equal weight bank ETFs because of the oil exposure that it does have, but it gives me exposure to the two largest and my two favorite banks in Canada, Royal Bank and Toronto Dominion. So that's kind of, again, each of those are nullifying the growth from the equity standpoint. So right now, these have just been great cash flow producers rather than they have been equity growers. But I think that time will change at some point in the future, but not at least until we start heading toward an interest rate cut cycle, because I'm seeing, again, concerns in the earnings, nothing that's substantial because the growth is still, pretty astounding. But we're heading into this market now where I think people are recognizing that we might be getting to the end of the ropes for end consumer spending, which means we could see some massive deflationary periods in product pricing, because that's the only option a lot of people that produce goods and GDP are going to have to do is cut prices to get people spending. And we're seeing that now in the housing market. I mean, for the first time, again, they're saying it's not going to collapse. What do they know? Analysts, but they're saying that the rental prices have started to come down. They're cooling off a little bit after the massive run up. We're seeing housing prices in what should be the busiest year for sales actually decreasing in housing prices by 1%. Again, when we say 1%, it's pretty incremental when the house is selling for $981,000 on average in April, which is crazy. But either way, across the board, we're starting to see a bit of a deflationary period in spending, especially on big time spending, which is the infliction of interest rates. And again, it's kind of a two-sided sword. We don't want housing to go up dramatically, but at the same time, we don't cut interest rates. The average person can't afford to buy a house. So let's start with Royal Bank. We got a whole slew of these to get through, so if it's a conversation you'd appreciate, as always, hit that like button, because I love Royal Bank. They're recently hitting an all-time high up over 36% from the October lows. What a great buying opportunity for these conglomerates, back over $200 billion in value, and no longer what I would consider to be a discounted buying opportunity, because as I told you, you just go look at the average historical yield of these companies, and when they spike up dramatically, that is when you buy, because the stock is usually down dramatically. And we've seen periods where Royal Bank hit over 5% in 2020 as of recently. I mean, the highest it hit was just around 5%, but now we're back to a more nominal level, which is below 4%. And the good thing is we're getting a dividend increase. They declared $1.42 per share, an increase of 3%. Earnings overall almost double digits for a lot of the a lot of aspects of their business, which we're going to take a look at, which is really intriguing to see. Basically net income was up 7%. They did very well against the backdrop of insane loan loss provision growth. We're still in this market whereas mortgage renewals come up, business loans come up, and any of these term loans come up, they're refinancing at much higher interest rates, which means the bank has to be like, hey, like the credit quality is starting to go down because they're producing the same or less cash flow, but they have to pay us more. So we need to put money aside in case they default. Now that they have default, we have to, it's a provision just in case, right? And it's up to $1.73 billion for the 6-month ending, right? They almost had $1 billion just for this quarter, $920 million, the highest we've seen in a very long time. That really affects a lot of the growth, but we're still seeing good revenue growth right across the board here. 14.1 billion versus 12.4 billion. Great revenue growth. Probably more related to the purchase of HSBC. They did purchase this is transactional cost. They actually have it listed in here. The Canadian counterpart of the HSBC bank, which I think is what's driven a lot of the extra revenue, a lot of the extra net income, which is great. I don't think there's anything wrong with it. It's a reason that I think Royal Bank's an incredible company. We've seen deposits grow by 14% year over year. So even if people aren't taking out loans, it's nice to see that Canadians continue to deposit a lot more. It just shows the scale and the growth of the Canadian economy and wealth management across a lot of these bank earnings. What you're going to notice is that a lot of people have been buying and trading stocks, a surprisingly large amount as of recently. So yeah, it's nice to see that Royal Bank, that HSBC purchase, brilliant. Everything across the board here I think was very nominal. It's a great company to own, and it's been proving itself as a buying opportunity every time it drops. So what does that mean for Toronto Dominion, the second largest bank? I think over time we are going to see this as probably one of the better buying opportunities in this current market, because we mentioned when all the banks crashed, that was the best time to buy. All of them have started to recover except for Toronto Dominion, because they can't get that dirty, news off their hands. I mean, they had laundering drug money coming into their bank, which I don't think was an affliction on their part. I don't think they're going to have to pay any major fines, because again, even if they were paying insiders, like if they were just kind of handing some money under the table to managers to let some money get by, but from my understanding and from what I've read, I don't think they can charge the bank for it, because it wasn't their fault to some extent. But again, it'll be a one-time write-off. I don't think it deserves to be hitting the bank as hard as it is with how good the earnings were, which we'll take a look at. But this has led to an all-time high record dividend yield for the second largest company in Canada at 5.71%. I mean, jaw-dropping. Never. You go back all the way to 2000, Royal Bank has never paid a yield this high. Question is, can they afford it? To get such a large exposure to a company, that answer is absolutely yes. I mean, their current payout ratio, if you take a look after their earnings, is 49.9%. Their dividend is so safe, it's insane. The revenue growth here, just like Royal Bank, it's not as great as Royal Bank, but it's nice. From a year ago at almost 12.4 billion to 13.8 billion. Again, provision for credit losses actually haven't been growing as dramatically. On a year-over-year basis, they're up a lot, but on a quarter-over-quarter basis, they're starting to nominalize a little bit here, which is pretty good to see. So hopefully we see that nominalization continue, probably more or less due to the exposure to the U.S. Canada has very expensive housing, whereas TD operates in the U.S. as well as Canada. Royal Bank only operates in Canada, so it's more likely you're going to see a spike in loan loss provisions, whereas in the States I think it's a bit more nominal depending on the markets TD operates in. However, these earnings were pretty decent. I gotta say, I'm like, it's not the worst thing I've seen, right? You take a look at over the 6-month ending, $2.90 versus $2.52. The 6 months prior, everything's pretty good. Obviously, if you look at a year over year, the diluted earnings were down a little bit, but I don't think this is anything bad. I don't see anything that's terrible here. And what's most fascinating to me is, again, look at the direct investing average trades per day. They are starting to go up. A lot of people have been trading stocks again, which I find fascinating, but the Canadian credit card spend is down. When you look at Canadian credit card spend, it's been across all the banks, basically they've been going down. To some extent. I mean, we've seen a little bit of a spike up from Q1 to Q2, but overall from a year ago, like, Canadians just aren't spending on their credit cards like they once were. And this is that sign that, obviously people that are making products are fighting to get that spend back, which I find just super interesting overall. So like I said, this is all going to kind of boil down to me buying VDY as my primary sole bank exposure, which gives me a lot of bank exposure. But I still feel like we're in this period that, if we can just kind of claw our ways through this inflationary cycle, these things should start to do exceptionally well. The revenues are great. The economy is still strong. We're just not seeing the same GDP growth we were because, again, spending is tight. And that can only start to alleviate once interest rate cycle cuts come. But taking a look at the other banks, BMO missed earnings. They guided, slower growth, and that really hit the stock hard because guidance hits the stock harder than anything else. But again, we're nowhere near where we were. We're still up 17% over a year ago, so doing pretty good. But again, they're looking ahead with a revenue forecast to grow 4.4% on average during the next 3 years compared to 5.1%, which was forecasted. So, analysts can really ruin a stock performance. But again, I look through the earnings. You're getting dividend increases here yet again. Let me just find this real quick for you guys, because they're saying that, $1.55 per common share, an increase of 5% to the prior year and 3% just from the prior quarter. So you're getting some good dividend growth there. Again, you read through the earnings. I don't see anything horrible here. I mean, you're still talking about great, revenue growth overall on the 6-month ending, or even just for this quarter, it's 7.9 billion versus 7.7 billion. Again, nothing crazy, but it's growing, right? So I don't think there's anything terrible here. I'm just not seeing anything that's bad. Bank of Nova Scotia has been pulling itself out of a hole. It's up 16%. This one has probably one of the largest yields at 6.58%. Performance relatively flat for the year, but again, you have to imagine that your entire return is just coming from the dividend. When you get to a 7 to 8% yield on some of the largest companies in Canada that have been very stable, have very low payout ratios, the capital growth is a cherry on top of the cake. These are full rates of return just from a yield. Canadian Imperial really pulled itself out of the hole, up 44%. Again, National Bank has just been unbelievable, up 16% this year. National Bank earnings were nice. Again, they're guiding a little bit higher. Guidance controlling everything here. Net income was up really nice. Overall, like I said, I think these banks are just proving to remain resilient. We're just, like I said, I think we get the excelled, the ignition, the best performance when liquidity becomes a bit better. People are more opening to buying things on a credit card. People are more opening to getting a mortgage or being able to get approved to get a mortgage. So it's nice that you get this mixed performance by like Pokemon cards. You collect them all, you're going to get a great average yield. And like I said, you don't know what ones will perform the best or the worst. I still think we'll eventually see a recovery in TD stock. These are just my humble personal opinions, but I will pass it off to you. I'd love to know what you think in that comment section below.